Picture this. You walk into a dealership, ready to finally go electric. Overnight, the sticker price jumps, not because the car changed, but because the rules did.
And here's the twist. The biggest price pressure might not be the 100% tariffs everyone's shouting about. It might be the rare earths and critical minerals inside your car, your phone, your MRI suddenly getting pricier or harder to get fast.
Today, 100% tariffs versus rare earths. What gets pricier first, and what it means for your wallet, your job, and the next decade of tech and energy.
Quick hit. The U.S. is ratcheting up trade pressure on China, with fresh attention on steep tariffs, including on electric vehicles, and broader Section 301 measures, as China warns Washington is inflaming tensions. Markets in China are wobbling on renewed trade war fears. Add to that, copper's been on a tear, driven by data centers, electrification, and constrained supply. If copper is the metal of electrification, near-record prices ripple through everything from wiring to EVs.
And the Pentagon, reportedly exploring a roughly $1 billion push to secure or stockpile critical minerals, rare earths, battery metals, so defense supply chains don't get caught flat-footed.
So the headline soup is this: higher tariffs, potential port fees, soaring copper, and a defense stockpile spree. Which hits first? Which hits hardest?
Let's zoom in. First, tariffs. When you hear 100% tariff, think the US doubling the landed cost of certain Chinese products. For electric vehicles, that's designed to block a flood of ultra-cheap vehicles. It's headline-grabbing, and yes, it can flow through to consumer prices or keep certain models out of the market.
Here's why it matters beyond cars. Tariffs aren't just walls, they're signals. They push companies to reroute supply chains, from China to Mexico, Southeast Asia, or US plants. That takes time and cash. And during that pivot, prices can tick up.
Now the rare earths piece. Rare earth elements, think neodymium for magnets, dysprosium for high-heat applications, are tiny in weight but massive in impact. They sit inside wind turbines, EV motors, fighter jets, and smartphones. If the Pentagon steps in with a $1 billion buy to secure supply, two things can happen. 1. Defense gets priority. 2. Civilian buyers may pay more or wait longer.
The magnets in a single utility-scale wind turbine can weigh several tons if it's a permanent magnet design. One component, one bottleneck. If supply tightens even slightly, project costs swing.
Copper next. Electric vehicles use more copper than gas cars. More wiring, more power electronics. If copper keeps climbing, it quietly raises costs across the board. New homes, grid transformers, charging networks. That's not a headline spike. It's a tide that lifts all bills.
And the port fee concept? Picture a per container or per transaction fee layered on top of tariffs for Section 301 goods. Importers feel it immediately. Some will pass it to wholesalers, who pass it to retailers, who pass it to you. It's not dramatic like 100%, but it's relentless like a parking meter that never turns off.
Cliffhanger number 1. In 60 seconds, the lever China could pull that would sting within weeks. And it's not a tariff.
Hold that thought, because this part matters. Markets in China are already signaling stress on perceived trade war risk. Bloomberg notes investors there are bracing for tighter U.S. measures, and that uncertainty can feed back into global risk appetites and currency swings.
Okay, here's that lever. Export controls. China has used permit regimes on strategic minerals before. If Beijing tightens export permissions on critical inputs, rare earths, graphite, or processing chemicals, you can see shortages not because of price, but because you simply can't buy the stuff at any price right now. That's a different kind of shock.
Let's map the ripples. Consumer wallets. Tariffs may keep certain Chinese electric vehicles off U.S. lots, propping up domestic and allied brands. But it might also slow price declines consumers were hoping for. Meanwhile, higher copper costs creep into household wiring, appliances, even data center-driven cloud costs.
Small business importers get squeezed. A potential port fee is not headline news, but if you bring in components from China, your cost structure changes on day one. Some will pivot suppliers, some can't. Those that can't may consolidate or close.
Industrials and defense see a lifeline. A Pentagon stockpile signals to miners and refiners, we will be a buyer. That can unlock financing for projects in the U.S. or allied countries. But in the short term, it diverts supply away from civilian uses.
Renewables developers face a double bind. They need copper and rare earth magnets for turbines and motors. Tariffs and fees raise capex, stockpiles constrain materials, higher rates don't help. If project bids go up, utilities may delay or renegotiate, timelines slip.
and the geopolitics. Reuters reports Beijing is blaming Washington for raising tensions and overstretching national security claims. Translation: retaliation risk. That can mean targeting U.S. goods, slow-walking approvals, or adding red tape for U.S. firms in China.
Cliffhanger number 2. After the break, the one sector that could unexpectedly benefit if tariffs bite and rare earths tighten. The surprise winner: repair and remanufacturing. If new gear gets pricier and parts are constrained, repairing older equipment and reclaiming magnets and metals suddenly pays. Watch for a boom in certified refurb for electric vehicle components, industrial motors, even wind turbine parts.
Lightning checklist. What to watch, what to do. If you're an electric vehicle shopper, track dealer inventory and incentives monthly. Tariff headlines hit selection before price. Watch Allied brand financing deals. If you're an investor, watch Chinese equity sentiment for spillovers. Monitor U.S. onshoring names and midstream processors. The first movers in Allied refining could own outsized margins.
For consumers on a budget, if you were already eyeing a big appliance or home wiring upgrade, get quotes now. Copper-driven cost creep rarely reverses quickly.
Countdown. Things to watch in the next 30 to 60 days. China's response tone flagging whether rhetoric turns to action, approvals, inspections, or targeted curbs. If copper prices stay elevated, expect pass-through into bids and consumer prices. Pentagon contracting or RFP signals on critical mineral buys. A $1 billion stockpile program would be a big starter gun for allied supply chains. Sentiment in Chinese markets and currency moves. If risk escalates, they may be implication to global equities, and commodities will matter.
And a wild card: a sudden export permit tweak from Beijing on strategic minerals. That's the one lever that can move from rumor to reality in a single circular.
Lightning round. Recap. U.S.-China tensions are rising. China says the U.S. is pushing the escalation. 100% tariffs make headlines, but port fees and copper costs can quietly hit prices faster. Pentagon eyeing a $1 billion critical minerals buy could secure defense needs but tighten civilian supply in the short run. Chinese markets are jittery on renewed trade war risk, signaling broader volatility. The near-term surprise winner: repair, refurb, and recycling of high-value components. Action list: map exposure, hedge copper, diversify suppliers, and plan for fees and permits.
And the core question we started with: what gets pricier first? Tariffs you can count or elements you can't see? The answer may be both, but the minerals move could land faster than you think.
If this episode helped you make sense of the noise, follow the show, hit subscribe, and tap the bell so you don't miss the next breakdown.